Hi, it's Isaac. We are continuing our illustration of the consolidated statement of financial position. In our previous tutorials, we saw the cost of control account, the non-controlling interest, the consolidated retained earnings for the November 2014 ICAG past question on financial reporting. Today we are looking at the consolidated statement of financial position as at 31st December 2014. Now, in our previous tutorials, we prepared the cost of control account and we got a final balance of 4,500 on the goodwill. So I'm going to start with that. So I'll put here my goodwill. So my CV sign, so this is goodwill. The amount is 4,500. That is a non-current asset. That's an intangible asset. Now we would continue with our PP and E. So PP and E. How much is the PP and E for parents? How much is the PP and E for sub? We're going to put them together. Parent, we are given 164,300. Subsidiary is given 85,500. Now, when you read through the question, and like we saw when we were doing the cost of control, we said that there was a revaluation of 9,000 of the subsidiary's asset. So, since it's a revaluation surplus, I'm going to add the 9,000 here. Then our question said that the 9,000, the asset that was revalued is a depreciable one, which was subjected to a 5-year depreciation. Since the revaluation was not brought into the books, it means that the asset was under depreciated. We did all that computation. We had a total of 1,800 under depreciation. So I'm going to deduct the 1,800 under depreciation from it. So we put all that together, we'll have a total of 257,000. So 257,000. So let me put this into bracket. So it is a sum of all that minus 1,008. That is giving us 257,000. Now there is also other investments. So we have other investments. You remember that our question said that the other investments on the balance sheet used to be 6,000. Now this was subjected to a fair valuation, and the fair value is now 8,400. We even recognize 2,400 on the consolidated income surplus here. So the 8,400 is what we will bring onto our statement of financial position. So 8,400 for other investments. So I'm done with the top side of it. Let me just put this together before I move on to the current assets. So the total will give us 269,900. I'll single underline because I'll be adding my current assets to it. So let me come on to my current assets. Of course, here we have inventories. Inventories. How much is the inventories of the parent? How much is the inventory of the sub? Inventory of the parent is given as 41,700. Inventory of sub is given as 31,200. So we put the two together and we get a total. But we said that parent sold goods to sub, and these goods contains an unrealized profit. We did a computation of the unrealized profits, and we realized that the total amount of unrealized profit is supposed to be 1,000, and that 1,000 is contained in the inventory of the subsidiary because they are the ones who bought. So we deduct the 1,000 from that. So the unrealized profit has been taken out of inventory, so we are now left with 71,900 for our total inventory, or our net inventory. We also have receivables. So receivables. How much is the value of receivable for parent? 34,000. What of the receivables for subsidiary? If there are any intra-group balances, for instance, if parent owes subsidiary, we'll take away the amount owed from here. If subsidiary owes parent, the amount would also be taken from here. From our question, we don't have any intra-group balances, so we would just forget about it. But assuming there is any intra-group balances, we'd have to take it out of receivables and also take it out of payables. So 50,700 is our total. Then there is bank. So let's look at bank balance. What is the bank balance for the parent? What is the bank balance for subsidiary? 2,700 plus 1,800, giving us a total of 4,500. So that is all for the current asset side. We put it together, we have 127,100. So 127,100. From this, I'm going to deduct current liabilities. Our question has already given us current liabilities. An amount of we have a total of 28,500 for the parents, 28,500 for parents, and then there's 15,000 for the sub. Again, like I explained earlier, if there are any intra-group balances, it will have to be taken out of the current liabilities, and we would have taken it out of current assets or receivables. So when we put that together, we get a total of 43,500. Then you remember our deferred consideration. It is due on 1st January 2013. So it means that it is due in 1 year's time. How much are we going to pay for the deferred consideration? We know that our deferred consideration payable, we computed it and we had 45,000. In actual fact, it is 22,500 shares at a price of 2 cedis per share. That gives us the 45,000. We did that computation earlier on. Apart from this, that is essentially all for our current liability. So I put the two together. We have 88,500. Current liabilities is 88,500. Current assets is 127,100. So we'll find the difference between the two, and that gives us 38,600. Now this difference of 38,600 is actually called net current assets. What I'm going to do is that I'll add my net current assets to my total non-current assets, right? So we have non-current assets of 26,900 and then net current assets of 38,600. So when we put the two together, we have 308,500, 308,500, and that is my, let me just call it my total assets or my net assets, or anyhow you want to. So currently I have considered all my assets plus my current liabilities. So I'm left with my capital, surpluses, and then my long-term liabilities. So let me bring my capital and surpluses. We are given our stated capital, and when it comes to stated capital, we only pick the stated capital of the parent, because you cannot add the stated capital of the sub to the parent when you are consolidating. So we pick the stated capital of the parent, which is 75,000. Capital surplus, we're giving capital surplus for parent alone to be 52,800. So capital surplus is 52,800. We don't have capital surplus for the subsidiary, so it is just the amount for the parent to pay. Then we bring our income surplus. You remember we prepared the consolidated income surplus and we had a balance of 97,681. So that figure is what we are bringing here. So the amount is 97,681. So that is our income surplus, 97681. Then I can now move on to the liability side, but let me squeeze NCI. I'm just going to add all the liabilities to it. So NCI, what is the balance on NCI account? When we prepared our NCI account, we had a balance of 29,019. So I'll bring it here. I can decide to sum days before I continue, but let me just put them together. So 29,019. So 29,019 is the NCI value. Do we have any other long-term liabilities? Yes, we do. You remember there's some 25% loan of which our parent has a stake in the sub. So let me bring my 25% loan. How much is the loan of parents? We are giving 36,000 for parents, and we're told that subsidiary has 12,000. But again, we're told that of this 12,000, 7,500 actually belongs to who? Parents. And for that matter, you realize that when we're looking at the investment side, we didn't bring the loan notes for the parents that is owned in the subsidiary. So we took it out of investment, so we also have to take it out of here because it represents an intra-group balance. Amount owed by one member of the group to the other is not to be considered when we are consolidating. So we put the two together and we have 40,500. So 40,500. The next thing is deferred tax liability. There is deferred tax liability, and a deferred tax liability is given for only the parent, an amount of 13,500. So 13,500. So after everything, we have considered all the amounts. We just have to put everything together, and the total gives us 308,500, which is in agreement with our total assets of 308,500 up here. So essentially, all that we have done so far is to present the consolidated retained earnings. We presented the non-controlling interest, the cost of control accounts, and then the statement of financial position for the November 2014 past version of ICAG financial reporting. On the balance sheet side, we started with the goodwill, and then we scaled it down to PP&E and other investment. At the investment level, we realized that parents also have investments in loan books that is owned by subsidiary. But because we said such amounts represent intra-group balances, we eliminated it at that level. We didn't bring it at all. Then, when we came down here, we also took away that same amount, 7,500. It was taken away from here. So it means that it has been eliminated. The current asset side, there are inventories. We picked that for parents. We added to the amount of subsidiary, and we deducted the unrealized profit from it. Receivables, it is yet the parent plus the subsidiary. We didn't have any intra-group balances to be taken away. If there are any intra-group balances like parents owe subsidiary or vice versa, we would deduct it from here. Bank balance, that is the amount for parents and the one for sub. Sometimes some of the adjustments we do to bank balances are cash in transfers. it is possible that parent could remit funds to subsidiary, which could be in transit. And it's also possible that subsidiary could remit funds to parents, which is also likely to be in transit. Where there are cash in transit, the amount would be added to our bank balance, and that's the only adjustment we normally do to this. Under the current liability side, we pick the parent amount, we added it to the subsidiary amount, and we have 43,500. There are no adjustments so far as this question is concerned, but assuming there are intra-group balances, that figure would also have to be taken away. Deferred consideration, this one basically has to do with recognition of the amount that is payable within 1 year. We're told that a deferred consideration, which is payable in cash, will be due on 1st January 2013. So we have brought the total amount payable, which is 45,000. You remember that earlier on this amount was discounted to 37,500, which is the amount that was brought in our cost of investments. Then we also calculated the interest component of it, which is 7,500, which was brought to our consolidated income surplus or retained earnings. From there, we move on to our capital and surplus side. Stated capital is always the stated capital of the parent. Fortunately for us, we are told that the share exchange has already been effected. Otherwise, we would have effected the share exchange ourselves by increasing our capital by the amount of capital that has been given to the subsidiary. Capital surplus, in our question, we didn't have any capital surplus from the subsidiary. It is only for the parent. Sometimes you do have capital surplus from the subsidiary, and sometimes there could even be post-acquisition capital surplus, meaning that you may have to prepare the consolidated capital surplus and eventually bring your balance here. Income surplus, we then prepared the consolidated income surplus or retained earnings. The final balance is what we brought here. NCI, again, we prepared the NCI account and we got a balance of 29,019. The 25% loan basically represents the loans that are owned by each of the entities, but we're told that parents has advanced 7,500 loan to subsidiary, so we have to eliminate it, which we have accordingly done. Deferred tax liability, the amount was given for only parents. We don't have deferred tax for liability for sub. If there were something like that for sub, we would have added to that of the parents. So after everything, we put it together, and the total we have there is 308,500. So this is how to present your financial statement, where the question is limited to the statement of financial position. In our next illustration, we'll be looking at how to present the financial statement when you are dealing with just the income statements.